I'm Becca Edil, and I'm a Director of Investments here at Versus. Prior to Versus, I worked at JPMorgan Asset Management in the Infrastructure Debt Group, where I was responsible for origination, due diligence, and evaluation of infrastructure debt opportunities in the US and Europe. Prior to that, I worked at IFM Investors, where I was also investing in infrastructure debt and was a portfolio manager. We like infrastructure debt asset class because it provides general characteristics of infrastructure. First is essential assets with high barriers to entry. Two is typically long-term stable cash flows from sticky demand base and contracts with strong off-takers. And third, it has low correlation to economic cycles compared to corporates. The added benefit of infrastructure debt is that it's senior in the capital structure, which means that infrastructure debt investors get priority in payment and liquidation over equity holders. Due to these factors, infrastructure debt volumes have grown tremendously over the last 10 years. We're seeing a number of attractive opportunities in infrastructure debt. The first one is that decarbonization targets are bringing opportunities in the renewable and energy transition sectors. In the renewables, these are opportunities like solar and wind farms, standalone battery storage projects. While in energy transition, we're seeing projects like renewable natural gas, renewable fuel, electric EV charging stations. We also expect that hydrogen and carbon capture storage will play a bigger role over the coming years. The second theme is digital infrastructure. We've seen a tremendous growth in digital infrastructure space with the onset of COVID-19 pandemic, which we expect to accelerate further with the rapid development of AI, which will necessitate the build-out of data centers and fiber networks. We believe infrastructure debt can provide a number of benefits to investor portfolios. Infrastructure is generally resilient through economic cycles and has shown historically low correlations to other asset classes. Lastly, historically low default rates. Resilient nature of infrastructure assets, generally tighter structures and covenant packages, and collateral backed by hard assets has resulted in historically low default rates and higher recoveries for infrastructure debt. Moody's Investors 38-year default study shows that infrastructure debt had 10-year default rate of 1.2% versus over 14% for corporate debt. Due to these factors, we believe infrastructure debt can play a complementary role in fixed income portfolios of investors.